Hey everyone, welcome back to the channel. I'm Doug, the retirement guy. YieldMax makes an announcement, a strategic update on ULTY. Again, you've seen it when they did the split, and now they've put it out there. They're making strategic changes to the fund again. Changes are ahead. ULTY, December 8th, they made the announcement. We're going to dive into exactly what their changes are going to be. To give you an idea, is ULTY dead and gone, or is it just rebuilding it to a new heights? Let's get into today's video. Well, ULTY overview and the core purpose. ULTY is an actively managed exchange traded fund designed to generate income through option strategies across U.S. Equities. Generate in current income. The primary goal is to produce that regular income for investors, exposure to the U.S. equities, and option tradings on about 15 to 30 underlying securities. Well, this has all been the same. This has been the same thing. They've kind of their goal from day one. So what really is the next thing that they're changing? Well, let's tell you this. Here's what the portfolio construction update will look like. ULTY is implementing refinements to the equity portfolio, inducing a more balanced model that includes expanded exposure and underlying reference assets. So they're going to take the high volatility equities, that primary engine for generating those option premiums, balance it with some low volatility large cap to enhance the NAV stability and that creates that resilience base. So kind of giving you a stable provider with a premium driver. So you have the one that's going to generate the income, one that's going to try to give you the stability. Expanding the diversification broadens the investment across various sectors, industries, and asset classes. The enhanced stability creates more resilient long-term base for the portfolio, and that balanced approach balances the options premium generation with a smoother investor experience. So portfolio construction updates. ULTY is implementing refinements to the equity portfolio, introducing a more balanced model that includes an expanded exposure to underlying reference assets. When I took and broke down exactly what they have now, from what they were able to give out and information-wise, technology is now down to a 40% base. Financials are at 23%. Communication services 8%, others is at 15%. So when I took their top, tried to get their top 10 across the board, you can see one, everything is weighted equally. So everything is in about 4.5 to 5.5 percentage of weight per category. So the other one is looked at in technology. You got the Broadcom, you got Amazon, you got the Alphabet. And I get those because that is part of the AI package. It's all part of regular technology as well. And again, each one of them is balanced in that 4.5 to 5% category. Then when I looked at financials, I saw that they went into the Bitcoin because they want that volatility from Bitcoin. So this time they went to the iShares Bitcoin Trust ETF. You know, they're going into the Palatar Technologies. They're going into the Coinbase, which they were before, but now they're balancing out in Coinbase. You got to throw Robinhood into the financials. So expanded diversification. I hate to say this, but I don't see it unless each one of the categories breaks down differently. But as sectors go, technology is technology, financials is financial. Enhances stability. Well, they got a lot more bigger names out there than the old try to find that upswing company, the one that's going to make the big change. And then the balance approach, I get them on their balance approach with the weighting across the board equally invested. And it's really equally invested by dollars, not always by percentage, but by dollars across the market. So I give them an A for that balance approach. I give it a enhanced stability. I don't, I see it at the bigger name, so okay, I'll give you maybe a B on that one. And the expanded diversification, I still see about the same, so we'll give you a C on that one. Now this one here, the option strategy expansion. This is the one that caught my attention when I said, well, we got to send this out to our viewers because we got to keep them updated. ULTY is implementing adjustments to its option strategies to manage downside risk while improving upside capture. So they're using a selective hedging strategies, which reduces severity of market declines and protecting gains into the future options. So what they're really doing with the hedging is they're using different pieces of the option tradings and all that into one big mix to try to help cover that downside. The upside, though, is the leverage option strategies, capturing more upside during market advances, enhancing returns without compromising objectives. Well, I've seen this with the different weekly paying ETFs. We see a lot of people using leverage, trying to gain growth, trying to give some natural growth in that market advancing, trying to multiply it. They never really classified how much leverage they're actually going to be using, but they're able to use leverage now into their fund. So I look back and say Roundhill has used leverage, Granite Shares have used leverage. So the question I have is how much leverage are they looking to do? The hedging, I get that, putting that bottom marker down below. It's kind of giving the adjustments to the responsibility of risk management, reducing that downward trend while trying to maintain some upside. I understand that. But they didn't clarify exactly what was going on. So it was almost in my eyes that they're trying to tell people, we're making changes, Don't leave, don't back out, stick with us. Now let's talk about the distribution outlook changes. Future distributions may be lower and less predictable, balancing cash flow with long-term stability. When I read that one, I was immediately saying, okay, there's more coming than what meets the eye. Distribution adjustments, that future distributions may be lower and less predictable to provide greater long-term stability. So what are they doing there? Well, they're not trying to be that ultra high dividend yield anymore. They're trying to come back down to be more of a balanced approach. The strategic balance, this adjustment aims to achieve a more stable investment experience with improved long-term growth potential. So again, they're talking about that they're not going to be putting out as much dividends because most people bought ULTY for one reason, that was income. Now they're telling you they're changing their philosophy to we're trying to give you some long-term growth with some investment, with some distribution. And the reason for their change was to lower the volatility assets and protective option strategies, reducing distribution levels to enhance the portfolio stability. So ultimately, they're blaming the distributions that they were chasing. And it's funny how I heard this and I thought about one of my videos, is chasing yield. How is it that they were at a point, they were chasing yield for you and I? They were chasing yield, trying to get as much yield as possible and lost track of the total return. So when we looked at the distribution history, you can see back, and this has all been adjusted to the split. So don't go crazy when you're seeing 90 cents. They never paid 90 cents. Yeah, with the adjustment split, basically they were paying a 90-cent distribution. As it sits today. So we readjusted all the cash amounts, went all the way through, and you see where they were paying 90 cents and now they're down to 58 cents. The distribution for this week they announced was 54.61 cents using 100% ROC. Okay, that's down 7.14% from the previous week. Is this what we're expecting to see, or are we expecting to see even more reductions down the road? So then we take a look at the price return from the leverage. This is one of the things that they bragged a little bit about, and they said the leverage can increase in markets and drop in poor markets. This is the danger. But what we see in the past 5 days, this fund, once they made their adjustments and made their changes, we started to see a growth in the fund. Now, did the markets change? Yeah, we're coming out of November into December. We've had the market adjustments. Now we're having some little bit of growth to it. And the first one I want to say is don't panic and don't freak out when you see that drop off at the end. That is the ex-dividend dates. The ULTY's price will decline by approximately the distribution amount, and that's virtually what that is. The cash leaves the fund to be paid to shareholders, and the leverage helps increase the share price. So even though with paying out the dividend, they're only down 0.13 in 5 days, so they've actually had a slight growth already coming forward. Is this big enough for me to jump back in? As I told you before, I've sold all mine off. Is it just doing something for me to jump back in? I'll explain that and answer that just shortly later, but realistically, no. So let me do this price return with that leverage. This is really what you have to understand across the board. Every ETF pays a distribution, experiences a decline in the net asset value, and that is on the X date of the fund. It is not a deflective that it's a fundamental feature of an ETF distribution. So as the NAV will go up and they pay their dividends on that trading day, you can see you have the wave, and then it's called recovery. How quickly can a fund recover? So the MAV behavior and the ex-dividend dates, it's all about when the cash leaves, how quickly can we return and get a recovery on the price. And the price return only evaluates the ETF based solely on the changes in the share price, ignoring the value generated through distributions. So total return is still the number one thing that we always need to focus on with ULTY. And we can add dividends back in, dripping it as we've always said, or we can do it and saying how quickly will it recover and get back to it. Leverage can help this, but I look very clearly, leverage is a double-edged sword. We've seen that in many different funds, and now they're going to start using it here. So the key risks that were still outstanding, derivative risks. That leverage risk is brand new. That leverage option strategies designed to capture more upside can also carry some potential greater losses. And this makes the NAV more volatile and sensitive to market movements. Now, the hedging strategy risks. Now, selective hedge strategies may not be effective in all scenarios or fully offset the losses. So the future options uses for hedging may not perform as intended. So these are some of the risks that I personally have and that we've put out there. And I still see NAV erosion is going to be a huge factor with this fund. So YieldMax's comments to us investors is YieldMax reaffirms its commitment to investors through a strategic enhancement to ULTY. Their balanced approach, their resilience, creating more resilient investment vehicles through the strategic refinements, transparency, maintaining transparency and strategy updates and risk management, and they now have a long-term focus, enhancing the long-term investor experience through improved risk adjustment returns. This is what they made the comments to the investors. So here are my comments. These are comments from me. I am not a professional investor. I am not a professional financial wizard. I am just a retailer that goes out and trades its own money. Will this change ULTY? I don't I don't see it being the change that we were all expecting. Will it make a change? Leverage will make some differences. Buying stable stuff will make differences. But will it make it the outcome that we really want it to be? Will it keep all ULTY as a high income ETFer? I don't know. I don't think so. Personally, I don't think so. But we don't know. Time will tell. Using leverage, good or bad? We've seen both sides. We've seen good. Roundhill does a very good job of it. We've seen Granite Shares has done a great job with it, but they've been attacked in the past month. Huge changes in Granite Shares valuation, but they didn't change their dividend so far. Time will tell everything. Maintaining that transparency and that strategic updates and risk management is critical. I expect to see reports on that on a regular basis, and when we do, we will let you know. But the biggest thing I can put out there is change. Change is happening to ULTY. Is it good change? Is it bad change? You tell me what your thoughts onto it. I was very clear, and I get a lot of people making comment that I push for YieldMax and do all this. No, I don't. I give you the information that's out there that you need to know with investing. ULTY was one of the largest funds that everyone talked about. There was videos galore about you can retire on ULTY and just that's the only fund you need to have. There's so many people have been affected by this that we want to make sure we're helping everybody with this information. So give me a comment down below. What do you think? Do you have enough change in ULTY to say yes, this is a good thing or this is a bad thing? Or again, if you're like me, or you just got the attitude that YieldMax burned itself, it's history, I'm out and staying out, tell me, am I on a only ship or am I on an island or am I the main flow? Let me know before.
Thank you for watching. Press the like button, hit the subscribe button, and join. Leave any comments